Welcome to this explainer. Today, we're going to completely flip how you look at trading charts. We're diving into a phenomenon that honestly drives almost every trader crazy. We're talking about why the market seems to actively hunt your stop loss, and more importantly, how you can actually flip the script by trading alongside smart money instead of constantly fighting against it. So, let's start with a really universal and deeply frustrating experience. Picture this. You've done all your analysis. You see a clear resistance level break. You buy the breakout, totally confident in your setup, and then almost instantly the price violently reverses, hits your stop loss, and then proceeds to run massively in your original direction. Sound familiar? You might think your broker is out to get you, or that you just have terrible luck, but the truth is actually much more systematic. You didn't experience bad luck, you became liquidity. Here is our roadmap for today. We'll cover the retail trap, understanding liquidity mapping, the liquidity sweep setup, our step-by-step entry strategy, and we'll wrap up with risk management and psychology. Let's jump right in.
Part 1. The Retail Trading Trap.
Traditional trading advice always tells you to find a strong support or resistance line and place your stop loss safely tucked just on the other side of it, right? Retail traders look at these zones and see safety. But smart money, and we're talking about the institutions, the banks, the algorithms driving massive volume, they look at those exact same zones and see fuel. They see a really dense concentration of orders just waiting to be triggered. To them, those obvious support levels are vulnerable liquidity pools that can be actively exploited to fill their own massive institutional orders. Moving on to part 2, understanding liquidity mapping. So what is a liquidity pool? It's simply an area dense with resting orders. Think of it like a massive, invisible magnet right there on your chart. When a bunch of traders go long at a support level, their sell stops are all clustered right below it. At the exact same time, breakout traders have sell stops placed there to short the market if it breaks. This creates a massive pool of sell orders. Now, for smart money to buy a huge position without driving the price up too fast, they actually need sellers. So they drive the price down, print a massive wick to trigger those stops, absorb the sell orders to fill their longs, and then shoot the market straight up. To map this effectively, you have to define your trading range before you analyze anything else. This helps you identify two completely distinct types of liquidity. On one side, we have external liquidity. These are your obvious range highs and range lows, the main swing points where those large stop-loss pools reside. On the other side, we have internal liquidity. These are the imbalances or fair value gaps, often just called FVGs, that are left behind within the range when the price moves too quickly. The market basically breathes by constantly moving back and forth between sweeping external liquidity at the edges and returning to internal liquidity to rebalance the charts. Now, you don't have to just guess where these pools are. Advanced traders use specific tools like liquidity heat map scripts on platforms like TradingView, or they dive into deep market mechanics with Bookmap, which visually represents resting limit orders right in the order book. But hey, even without advanced software, you can spot these areas simply by looking for consolidation zones. A clean, flat top on a chart, a series of equal highs, is basically a massive neon sign saying that liquidity is resting just above it.
All right, part 3, the liquidity sweep setup.
Here is where you really have to reframe how you think about false breakouts. A false breakdown isn't random bad luck. It's actually a strictly necessary part of the market model. It is a deliberate, algorithmic sweep designed specifically to grab that liquidity we were just mapping out. The market literally cannot make its true intended move until it has secured the necessary fuel. The fakeout isn't a mistake. The fakeout is the setup. Let's look at highly liquid assets like Bitcoin and gold. If you check out a multi-session map of gold, you're going to consistently see obvious retail support levels swept right at the start of the highly volatile London or New York sessions. The price spikes down, grabs the liquidity, and immediately reverses. Or take Bitcoin. Equal highs often form over a quiet weekend, right? Retail short the double top. Then, come Monday morning, a massive green candle wicks up, sweeps all those stops, and then executes the real drop. Okay, part 4, our step-by-step entry strategy. By rigidly following these 4 exact steps, you essentially remove all the emotional guesswork. Step 1, mark the previous day's high and low or the previous session's high and low. Step 2, identify any obvious consolidation zones. You're looking for those equal highs and equal lows. Step 3, do nothing. Seriously, sit on your hands and wait for the price to aggressively push through those levels in a liquidity sweep. And finally, step 4, do not try to catch the falling knife. Wait for the market structure to shift back in the opposite direction before you enter. Let's refine that final step for a second, because honestly, this is where the magic happens. For an absolute A-plus setup, you want a compounding set of confirmations. First, you see the sweep of external liquidity, the fakeout. Second, you want to see a change of character, or a break of structure on a lower time frame. This just means the price aggressively reverses and breaks the previous swing point. Third, that aggressive reversal will usually leave behind an imbalance, an internal liquidity fair value gap. Your precise entry happens when the price pulls back to retest that fair value gap. You put your stop right behind the sweep wick, and you target the opposing liquidity pool.
And finally, part 5, risk management and psychology.
There is one mantra you absolutely must memorize here. Trade the reaction, not the prediction. When you see equal highs forming, it is incredibly tempting to jump in early and try to predict the sweep. Please do not preempt the move. You must wait for the liquidity sweep to actually happen and for the structure to shift before you ever risk a single dollar. Mastering this strategy means developing the cold, calculated discipline of an algorithm. You have to watch massive green candles pushing through resistance and actively choose not to chase them. You've got to sit back, knowing the reversal is likely coming. It takes serious patience to wait for clean setups. And crucially, it requires accepting that even with the best analysis, you will still sometimes get stopped out. But by aligning your risk with these high-probability liquidity sweeps, your winners are going to vastly outpace your losers over time. So, I'm going to challenge you to put this into practice today. Go open your charts right now, look at Bitcoin, look at gold, or whatever asset you normally trade. Identify the obvious highs and lows from yesterday and ask yourself this final question. How often does the price wick through those exact levels only to immediately reverse? See if you can spot those smart money footprints hiding right there in plain sight. Because once you start seeing the market through the lens of liquidity, you will literally never look at a chart the same way again. Thanks for joining me on this explainer.